For the last 15 years, the S&P 500 has crushed everything else. But trees do not grow to the sky. The United States stock market is now trading at 25 times earnings, while emerging markets are trading at 10. The greatest wealth transfer of our lifetime is about to happen as capital rotates out of the dollar and into emerging economies. Goldman Sachs is already doing it. Bridgewater is doing it. Here's how you can invest in the next global superpowers before the crowd arrives. You are suffering from a condition called home country bias. It is the subconscious belief that the economy you live in and the currency you earn in is the only safe place for your capital. For the last decade, this bias has paid off. American exceptionalism was not just a political slogan. It was a financial reality. Tech stocks printed millionaires while Europe stagnated and China cracked down. But in finance, what worked yesterday is rarely what works tomorrow. We are standing at a pivotal moment where the macroeconomic tectonic plates are shifting. Let us look at the cold, hard data. The Shiller PE ratio for the U.S. market is hovering near historic highs, rivaling the dot-com bubble and the 1929 crash. This metric adjusts earnings for inflation over 10 years. It tells us that for every dollar of earnings, you are paying a massive premium. Meanwhile, look at the valuations in Brazil, India, Vietnam, and China. They are trading at single-digit or low double-digit multiples. This is the widest valuation gap we have seen in 20 years. The last time the gap was this wide was the year 2000. Everyone thought the US tech sector was invincible. Then the bubble burst. From 2000 to 2010, the S&P 500 returned basically 0%. It was a lost decade for US investors. But if you held emerging markets during that same period, you made massive returns. History does not repeat, but it rhymes. And right now, the rhyme scheme is screaming mean reversion. Mean reversion is the gravitational force of finance. Asset classes that outperform for long periods eventually underperform, and the laggards eventually become leaders. It is mathematical inevitability. The US market currently comprises nearly 70% of the global equity market cap, yet the US GDP is only about 25% of the global economy. This disconnect cannot last forever. The catalyst for this shift will be the US dollar. For years, a strong dollar has acted like a wrecking ball for emerging economies. When the dollar is strong, it is expensive for developing nations to service their dollar-denominated debt. It crushes their growth. But look at the Federal Reserve's position today. They are trapped. With $34 trillion in national debt, the U.S. government cannot afford to keep interest rates high forever. The interest payments alone are consuming the tax revenue. The Fed will eventually have to cut rates and print money to monetize the debt. This is not a conspiracy theory, it is simple math. When they do, the dollar will weaken. And when the dollar weakens, it acts like a shot of adrenaline for emerging markets. Their debt becomes cheaper, their exports become more competitive, and foreign capital flows in to capture the currency appreciation. This is the macro cycle play of 2026. Let us talk about where this capital is going to go. We need to look at India. India today is where China was in 2005. It has the demographics. The median age in India is 28. In the US, it is 38. In Western Europe, it is 44. A young population means a growing workforce and a growing consumer class. They are digital natives. The infrastructure build-out in India is happening at a pace the West cannot comprehend. However, India is not a secret. The valuations there are already somewhat rich because everyone knows the story. But growth justifies the premium. You are buying a country that is projected to become the third largest economy in the world by 2027. The digitization of their financial system means millions of people are entering the banking system and the stock market for the first time. Domestic liquidity is supporting the market, making it less reliant on foreign fickle capital. Now, let us address the controversial one, China. The sentiment on China is at an all-time low. The real estate crisis, regulatory crackdowns, and geopolitical tensions have made it uninvestable for many Western funds. But remember the rule of the smart money. You want to buy when there is blood in the streets. Chinese tech giants, companies that dominate cloud computing, e-commerce, and artificial intelligence are trading at valuations that look like utility companies. You do not have to like the government to like the risk-to-reward ratio. China is pivoting from an infrastructure-based economy to a high-tech manufacturing economy. They lead the world in electric vehicles, batteries, and solar panels. While the West fights inflation, China is fighting deflation. This means their central bank has room to stimulate while ours is restricted. A small shift in sentiment, just a reversion to the mean, could trigger a massive repricing in Chinese assets. You are buying $1 for 50 cents because everyone else is too scared to pick it up. Then there is the commodity play. Emerging markets are resource-rich. Brazil, Saudi Arabia, Indonesia. We are entering a period of resource scarcity. The transition to green energy requires massive amounts of copper, lithium, and nickel. Who has these resources? Not the G7 countries. The global south has them. As the dollar weakens, commodity prices priced in dollars tend to rise. Investing in these markets is a double hedge. You hedge against the dollar devaluation, and you hedge against inflation. Let us discuss the risks, because this is not a free lunch. Emerging markets are volatile. You have currency risk, political risk, and regulatory risk. In the US, you worry about a recession. In emerging markets, you worry about a regime change or a currency crisis. This is why you do not put 100% of your portfolio here. But having 0%, that is reckless. That is betting that the last 10 years will repeat exactly, which almost never happens. The standard advice of a 60-40 portfolio usually implies 60% US stocks and 40% US bonds. This is a recipe for mediocrity in the coming decade. The modern portfolio needs global diversification. We are talking about allocating perhaps 20% of your equity exposure to these high-growth regions. So, how do you execute this? You do not need to fly to Mumbai to open a brokerage account. The ETF market has democratized this trade. Tickers like VWO or IEMG give you broad exposure to the entire emerging market basket. They own thousands of companies across China, India, Brazil, and South Africa. You get the growth without the specific company risk. For those who want to be more surgical, you can look at country-specific ETFs. But be careful. Single country funds can be incredibly volatile. The broad basket approach allows you to bet on the macro thesis is that the dollar will fall and the global south will rise it. It's out needing to predict which specific country will win the race. Let us go deeper into the psychology of this trade. Why is it so hard to sell your Nvidia and buy a basket of Brazilian banks? Because of recency bias. You look at your recent statements and see green in US tech and red in international stocks. Your brain tells you to stick with the winner. But professional investors look at forward expected returns. Vanguard, one of the largest asset managers in the world, recently released their 10-year outlook. They project US large-cap stocks to return roughly 4% annually for the next decade. They project international emerging markets to return roughly 7 to 8%. Over a decade, that difference is massive. It is the difference between retiring early and working until you are 75. Think about the structural problems facing the US economy. The deficit is 6% of GDP during peacetime and full employment. This is unprecedented. The political polarization makes structural reform impossible. The cost of living crisis is squeezing the consumer, which is 70% of the US economy. The engine is sputtering. Meanwhile, look at Southeast Asia. Vietnam, Indonesia, the Philippines. These are economies growing at 5 to 6% real GDP. They are manufacturing hubs. Supply chains are diversifying away from China, and these nations are the beneficiaries. This is called the China Plus One strategy. Corporate America is building factories in Vietnam and India. If corporate America is moving its capital there, why aren't you moving your investment capital there? You also need to consider the currency aspect of your portfolio. If you live in the US, your house is priced in dollars. Your salary is in dollars. Your pension is in dollars. If the dollar loses 20% of its purchasing power over the next 5 years, your entire life gets 20% more expensive. Holding foreign assets is an insurance policy. If the dollar tanks, your foreign stocks become more valuable in dollar terms. It preserves your global purchasing power. Let us talk about the timeline. This is not a trade for next week. This is a position for 2026 and beyond. Cycles take time to turn. The dollar might have one last squeeze higher before it breaks. The US market might have one last melt up, but you build the arc before the rain starts. You start dollar cost averaging into these markets now, while they are cheap and hated. When you hear your friends talking about how the US is the only place to invest, smile and nod. That is the signal. When the taxi driver tells you to buy Nvidia, the top is near. When the magazine covers say China is uninvestable, the bottom is near. Contrarian investing is lonely, but it is profitable. We are moving towards a multipolar world. The era of total US dominance is fading. Not ending, but fading. We are seeing the rise of the BRICS nations. We are seeing trade being settled in yuan and rupees. We are seeing a fragmentation of the global order. Your portfolio needs to reflect this new reality. You cannot invest for the world of 1990 using a playbook from 1990. The opportunity cost of ignoring this shift is high. Imagine sitting out the US tech boom of the last decade. That is the risk you take by sitting out the emerging market boom of the next decade. The valuations offer a margin of safety. When you buy something at a PE of 10, a lot of bad news is already priced in. When you buy something at a PE of 30, perfection is priced in. And the world is rarely perfect. So, here is your action plan. Audit your portfolio. Calculate exactly how much exposure you have to the US dollar and US equities. If it is over 80%, you are dangerously concentrated. Look at the fee structures of emerging market funds. They are often higher, so shop around for low expense ratios. Start slowly. Shift 1 or 2% of your portfolio per month. Use the volatility to your advantage. If China drops another 5% on bad news, buy more. If the US market rallies to new highs, trim your winners and rotate the profits. This requires discipline. It requires ignoring the noise of the daily news cycle. The narrative will change. By 2026, the headlines will read the emerging market century and why the US is stagnating. By then, the easy money will have been made. The early adopters, the people watching this video, will be selling to the latecomers. Do not let patriotism blind your profit potential. Capital has no nationality. It flows to where it is treated best. Right now, US valuations are hostile to new capital. Emerging market valuations are rolling out the red carpet. The data is clear. The cycle is turning. The only question is, will you move with the tide or will you be left stranded on the shore?